So, what makes a good business development company, or BDC, for investors? Now, this is a really important question when we're looking at potential investment targets. So look, hey guys, if you're new to investing, or if you're looking to really boost your income through dividends, there's nothing better than understanding BDCs, and understanding them is indeed crucial, because these investments are unique and they're really interesting investment vehicles that can offer some really substantial benefits. But of course, they do come with their own set of complexities and nuances as well. My goal here today is to really help you to navigate these waters with confidence. So, why then should we even care about BDCs? Why focus on BDCs? And the key thing is, for starters, they play an absolutely vital role in the financial ecosystem. They provide funding to the smaller and medium-sized businesses over the country that might otherwise struggle with securing traditional financing. Now, this is a really important point because it means that they only really generate income for investors, but they also are providing support to the growth of the wider business and economic environment. Not only are they good investments, they also help small companies and growing companies and promising companies. Now, for new investors like yourself, understanding how BDCs operate and what makes them good investment targets can really impact your overall portfolio performance. So look, the right BDC can offer stable and increasing dividends. Now, this is exactly what you're going to want if you are focused on growing your portfolio and your investment income. So, what do we need to look for? Well, in this video, we're going to break down everything that you need to know about BDCs. We're going to go through some of the basic definitions about what they are, as well as some of those key operational mechanics that are really important to understanding those characteristics that make BDCs a really worthwhile investment. Now, on top of this, we're also going to really dig into some of those essential financial metrics, as well as some of the risks that are associated with this type of company. Now, finally, I'm going to share some tips on how to research and how to choose the very, very best BDCs that are going to fit your individual needs and your individual investment goals and your portfolio. So please do stick around. Now, by the end of the video, I want you to have a really good, solid understanding of what BDCs are, and I want you to also be able to be equipped and ready and able to make informed investment decisions. Now, let's get started, my friends. So when we think about this, the first thing to really understand is, what are business development companies? What are these BDCs? What is special and unique and interesting about them? So in a very simple definition, let's get through the first things first. What is this thing? What is this business development company? What are they? Where do they come from? Now, essentially, a BDC is a special type of almost a closed-end fund. It invests in small and medium-sized businesses. Now, these companies, well, they will often have difficulty accessing traditional forms of financing for growth. So they might have difficulty getting sufficiently sized bank loans or public stock offerings. So they're sort of in that sweet spot, or the not so sweet spot, where they're too big and too small. And this is where the BDCs come in. They're going to provide a much needed source of funding for these companies. That enables these companies to grow and to be very, very successful and thrive. So the next question that we need to think about is, how do they operate? How do they generate income? And the answer is that they do this through a combination of different elements. Now, they're going to get some income through interest, through dividends, as well as through capital gains. Now, look, when a BDC lends money to a company, it's going to earn interest on that loan. And if it takes an equity stake in that company, it can also receive dividends. Now, this is really important and really interesting. And so there's often several different sources of finance, fund money coming in as an investment. Now, if the companies they invest in do really well and the value of that company increases, then the BDC can actually also realize capital gains by selling their stake in these companies. So another really important element to understand here is the regulatory frameworks that govern BDCs. Now, they're regulated by the Securities and Exchange Commission, the SEC, and that imposes very, very specific rules that will give us an option, or give us the opportunity to have much more transparency to protect us as investors. Now, a key rule here is that BDCs have to distribute at least 90% of their taxable income as dividends to their shareholders. Now, this requirement makes them very, very attractive for income-focused investors and people looking to boost their income, like myself, maybe like you as well, and it can ensure a very steady stream of payouts, either monthly in some cases or quarterly. But it's also necessary to understand what a BDC is and how it operates to really have the foundation here to understand whether or not this is going to be a good investment and fit you and your portfolio. Now, my friends, as we move forward, I want to go a little bit deeper into some of the characteristics now that actually, distinguish and separate the strong BDCs from the other BDCs. Now, by getting into these basics, I'm hoping you're already very much well on your way to making a much more informed investment decision. So when we think about this, then what are the characteristics of the very best and the very good BDCs? First of all, I like to see a very strong management team in place. And this is really one of the first things I look for in a BDC. It's difficult to assess and judge in many cases, but it's a strong, powerful, experienced management team. And it really is the expertise and the experience of the people running the company that is really going to make a substantial and significant difference over the long term in the performance of this company. Now, a management team with a strong track record of successful investments, this is absolutely invaluable. Now, this management team has to have the know-how. They have to be able to identify promising opportunities as well as the skills and capabilities to navigate challenging circumstances that may arise. Now, this comes from a range of industry expertise that plays a really important role here, and it's the managers who really understand that range of sectors that they are investing in. That's going to enable them to make better assessments of the risks and the potential and make better, much more informed and meaningful investment decisions that are going to support us as investors. Now, another key thing, number 2 here, is the diversification. Now, a well-diversified BDC is going to spread the investments over various industries and companies. Now, you might ask, well, Lincoln, why is this important? And the answer is because diversification is going to reduce your risk as an investor. Now, if one sector underperforms, then the impact on your overall investments will become minimized. So a diversified portfolio is simply going to contribute to the stability and consistency of the income. Now, when a BDC invests over a range of different industries, it's going to be less vulnerable to economic downturns that may affect a specific sector or regulatory changes that might affect that particular sector. Another really important point here is also high quality investments. Now, this is certainly not the least, but it's the last on these 3 points here. We need to focus on the quality of these investments. Now, really great BDCs invest in financially healthy companies with strong growth potential. Now, that might sound obvious, but it's really these high quality investments that are crucial to helping the BDC maintain and increase dividends with time. And that's what every income investor is looking for. Now, by choosing companies with solid financials and promising futures, then BDCs can provide more reliable returns to us as investors over time. Now, look, when I wrap this all up, when I'm evaluating a BDC, I want to pay close attention to the management team, to the level of diversification that they have over their portfolio, as well as looking at the quality of those investments altogether. Now, these characteristics are, together, for me, key indicators of a BDC's potential to deliver stable and growing income for me as an investor. Now, these are, in some cases, easier and harder to assess, and we'll also look at now some of the financial metrics that we can use to assess BDCs. Now, financial metrics are important because they can be objectively understood. A key one here is the net asset value. Now, it's really important to understand this net asset value, or NAV, because it's calculated by subtracting the company's overall liabilities from its assets. So essentially, this is representing the value of the BDC's investments minus what it owes. Now, tracking the NAV over time also provides us with a really, really clear picture of the company's overall performance. Now, this is important because a rising NAV going up and to the right indicates that the BDC is making really profitable investment decisions. On the other hand, a declining NAV is, for me at least, a very strong red flag and indicates this is a company that I'm probably not going to be investing in. It's important also to look at the dividend yield and the coverage ratio. Now, this is a really crucial metric. Now, this is easily calculated by taking and dividing the annual dividend payment by the stock price. Now, the high dividend yields can be obviously attractive to many income-focused investors, but on the other hand, it's really important to dig deeper and understand what's going on here, because a really high yield might signal some underlying issues by the company. And we need to make sure that this dividend is being supported and covered by the earnings. And this is where the dividend coverage ratio comes into play, because this ratio measures how well the BDC's earnings will cover their dividend payments. Now, a higher coverage ratio is, of course, for me important, because it's going to indicate that the dividends are more sustainable, and that provides me as an investor with much more peace of mind about this income stream. And that, my friends, is important. Now, I also spend a lot of time looking at the leverage ratio. Now, this is a simple measure and a simple metric which shows simply how much debt a BDC uses to finance the investments. Now, while leverage can enhance returns by allowing the BDCs to, make bigger investments and more investments than they otherwise could with just the equity that they have, it also acts as a double-edged knife, and it's also going to increase our risk as an investor as well. So more leverage can lead to financial instability, especially during market downturns. Now, on the other hand, moderate leverage, if well managed, can amplify returns found by the BDC management team without adding excessively to the risk. So there's a balance act here. Now, keeping an eye on these, financial metrics, the NAV, the dividend yield coverage ratio, and the leverage ratio, and I think you're going to be better equipped to evaluate whether or not a BDC is going to be a good investment target. So, when I'm looking at a BDC, some of these metrics here are going to be very, very useful, because they give me very valuable insights into what's going on in the company. And of course, there is a lot of data here as well, where I can get the metrics and get these numbers, and I can understand if the BDC is going to give me consistent income. So, it's not all rainbows and unicorns, my friends. There are some risks here. Number one, credit risk. Now, one of the biggest risks associated with BDCs is credit risk. It's the risk that these companies in the BDC's portfolio may actually default on the loans to the BDC or some of their other financial obligations. Now, if a portfolio company actually fails to meet their debt payments to the BDC, well, that's not so good now, is it? And it can significantly impact the BDC's income, and consequently, it's going to impact the dividend coverage ratio and their ability to pay dividends to me as an investor. So good BDCs, well, they're going to be carefully managing this credit risk with thorough due diligence and continuous monitoring of their portfolio companies. They're going to assess and carefully assess the financial health of the companies, the management quality of the companies, the growth prospect of the companies, and they're going to assess this very carefully before they make an investment in that company, as well as monitoring this on an ongoing basis. Number two here, interest rate risk. And this is a really important risk as well, and it simply refers to the risk of changing interest rates and how this might impact the BDC's earnings. Now, we've sort of seen this recently with the rising interest rates, and the cost of borrowing has increased for many BDCs, but it's also increased the income coming into the BDCs. But it can, for a while, reduce the BDC's profit margins. Now, additionally, these higher interest rates can actually make it really challenging for the portfolio companies to service their debt. The interest rates go up, their debt payments increase, and it puts more pressure on the portfolio companies, and this heightens the likelihood of default. Now, to mitigate this risk, a good BDC can use a range of different strategies. They could use fixed rate borrowing, or they could choose to hedge some of the interest rate exposure. But really, look, understanding these risks is going to become crucial for us as we look to make informed investment decisions. And while BDCs do offer attractive income potential, they also come with inherent risks that we do need to be careful about, and we do need to manage carefully. By focusing, though, on how the BDC handles credit and interest rate risks, as an investor, you're going to be in a much better position to assess the sustainability and stability and the potential then for the BDC to provide you with consistent income and consistent returns. Simply being aware of these risks and how they can be managed is going to help make you a much smarter investor and allow you to make better, smarter choices when you are considering adding BDCs as a key part of your investment strategy. Now, I want you to always remember as well, a well-managed BDC is going to have robust measures in place to mitigate these risks. It's going to help them to ensure that they've got stable and reliable income for you and for the other investors. So how then do we research and select a really good BDC? Well, the key thing here is analyzing the financial statements. But when it comes to researching and selecting really good BDCs, the first step here is simply to analyze those financial statements that are available. Now, these documents will give you a wealth of information about the BDC, about their performance, and about their financial health. And all of these are really important points to keep in mind. Now, the key statements to examine are going to include the income statement as well as the balance sheet and the cash flow statement. Now, the income statement is going to show us whether or not the company's revenue, expenses, and profitability are trending in the right direction. The balance sheet is going to give us a snapshot of the assets that the company has as well as their liabilities. The cash flow statement is going to give us a look at an X-ray image of how the company is effectively managing the cash and the flows of the cash for their company. Now, I also find it incredibly useful to read analyst reports as well as the company's investor presentations. So these are really, really valuable, and they have been prepared. The analyst reports were prepared by financial professionals, and they thoroughly understand and they have thoroughly researched the BDC. Now, these reports give us some insight into the company's performance, the risks, the specific risks for this company, as well as the future prospects. Now, analyst reports often give us a very nuanced view that's going to go way beyond those raw numbers that I might see as an investor in the financial statements. But I also think we need to not overlook the investor presentations, because these presentations are usually freely available on the BDC website, and they're going to give us a very clear understanding of the management strategies, their goals, as well as their overall outlooks for the company and the earnings into the future. Now, these reports and presentations will also include updates on the overall company's portfolio performance, any new investments that have been made, and any other really important key developments that the management team thinks important. Now, wrap all of this together, statements, the analyst reports and investor presentations, you too can get a very comprehensive view of the BDC's financial health as well as their strategic direction. I think it's this multifaceted approach that's going to be useful to help you make more informed decisions when you're evaluating potential BDC investments. So look, overall then, in summary, I think thorough research is absolutely crucial to help you identify a really powerful and good BDC to include in your investment portfolio. By analysing financial statements, reading analyst reports, and reviewing investor presentations, you're going to get really valuable insights into what's going on with this company, this BDC, how it's performing, and what the growth prospects are moving forward. Now, adding all of this together, all of this knowledge is going to help you to select the best BDCs that's going to fit with your investment goals, as well as, most importantly, as well as fitting your risk tolerances really well. So let's wrap this up really quickly. What are the key points that I've looked at today? Well, first of all, we talked about what a business development company actually is, what a BDC is, how they operate. And there's this type of closed-end fund that's going to invest in small and mid-sized companies and businesses, and it's going to provide them with some really much-needed funding. We then discussed how BDCs operate, how they generate income, what they're going to do, and how they bring the income in from interest, from the dividends, and also from capital gains, all while being monitored and regulated by the SEC. We then look at the key characteristics of good, strong BDCs, with a particular focus on the strong management team with a good, deep industry expertise, a powerful and diversified portfolio that can help us to reduce risk, and also how the high-quality investments are going to be absolutely essential components that will contribute then to the BDC's stability and income potential. So, what else do we look at? It's very simple in many cases to understand, because we can also then look at the financial metrics such as the net asset value, such as the dividend yield and the dividend coverage ratio, as well as the leverage ratio. Now, these metrics can absolutely help us to evaluate a BDC's financial health as well as their ability to provide consistent income and consistent returns to us as investors. We also touched on some of the risks, and never ever forget risks, my friends, when you are investing. And there are specific risks with BDC, such as credit risk, such as interest rate risk. And, really we need to look at how a good BDC can manage some of these risks and some of these challenges. Now, finally, we talked about how to research and select good BDCs by looking at financial statements, by reading analyst reports carefully, and also by reviewing the BDC investor presentations. Now, these steps are going to help us and equip us with the insights that we need to make good informed investment decisions as we look to add BDCs and shift our investments within BDCs in our portfolio. Understanding BDCs can really help you to grow your income and help you to grow the dividend payments that you get. By applying the knowledge from this video, I'm hoping that you'll be better prepared to identify both promising investment opportunities in BDCs, as well as getting into some of the specifics for the BDCs and learning how to shift your investments. Now, thank you very much for joining me here today. And if you found this video helpful, don't forget to smash that like button, smash that subscribe button, and stay tuned for more interesting, useful, and